Good afternoon to everyone. Continue with where we
Good
ended this meeting.
afternoon.
Yes, so I hope everyone is fine. We'll just continue with where we ended the consolidation for foreign subsidiaries. So we started with the consolidation of foreign subsidiaries this morning. We dealt with everything. And we were on illustration 1. And with the illustration 1, 2, we completed with workings 2, net asset. So we move straight with the goodwill calculation. So the question said that, where is it? Yes, the NCI are valued using the proportionate asset method. So you use net asset proportionate method for goodwill as well. So proportionate also starts with cost of investment, and we calculate it in the subsidiaries currency. So that one is cedis. So what was the cost of investment in the subsidiary? So they say they paid what? 7.5, the cost of gaining control. So that is with the cost of investment. So 7,500. Now this one is what? Proportionate method. So we will calculate net assets at acquisition. We are saying that at parent proportionate. Remember the proportionate method. So we said parent percentage is 80% multiplied by net asset at acquisition of the subsidiary. That's how it works. 6,000 here at acquisition, 6,000. So what is the figure? So this will be your goodwill at acquisition, whatever you get. So please, what is the answer?
4,800.
4,800. So the goodwill at acquisition becomes sorry, excuse. So what is the goodwill? There is no impairment. So goodwill at acquisition.
2,700.
There is no impairment. So goodwill at acquisition will be the same as goodwill at reporting. Goodwill at acquisition will be the same as goodwill at reporting. Now we have to retranslate the goodwill. Okay, retranslate goodwill. So the pro forma is here. The second method, I won't show you the pro forma. This is the first question. That's why we are using the pro forma. So opening goodwill, you don't have opening goodwill. Replace it with what? Goodwill at acquisition. Opening goodwill will be placed at goodwill at acquisition. So you start with the subsidiaries currency. The second column will be exchange rate. The last column will be what? The gross currency. So goodwill at acquisition will be the same as our goodwill at reporting here, at as opening goodwill. Okay, so goodwill at acquisition will be 2,700. There is no impairment. You leave a line. Then you come to your closing goodwill. Closing goodwill will be your goodwill at reporting. Or you can just write closing goodwill. Because there is no impairment, our goodwill at reporting will be the same as goodwill at acquisition. So opening goodwill and closing goodwill in this case will be the same thing. But when you are translating, changes will come in because of what? The rate. So now the difference will be the exchange gain or loss. Nothing will come here to go to this side. All right. So you translate this closing goodwill using the closing rate. If there was impairment, you retranslate it using the average rate. The goodwill at acquisition will be the acquisition rate. So let's pick the rate from the question. 1st July. Okay. 1st July is the acquisition date, so that will be acquisition rate 1.5. The closing rate is 2 cedis.
The
So please,
1.5 is 1.8.
So 1,800. The closing will be
1350.
so the difference will it be an exchange gain on or exchange loss?
This exchange loss,
Yes, it has reduced in value.
45.
Come again with the figure.
450.
Now the first one, we shared the loss in the net asset between what? Parent and NCI. So with this one, are you going to share the exchange loss? No. Why? Because the company uses proportionate net asset to value their NCI and also calculate their goodwill. But you would have shared it if the question said the NCI are valued using the full method or the fair value method. All right, because we established this done that if you use if the full goodwill method has been used, gain and losses will need to be apportioned between group workings 5 and also the NCI workings 4. And if the proportionate goodwill method has been used, then all of the exchange gain and loss is attributable to what group. So this, because we are using the proportionate method to calculate goodwill and to value our NCI, therefore, all the exchange loss as a result of this goodwill retranslation are borne by what? The parent. Borne by the group. Okay, borne by the group. Because what? The proportionate method was used to calculate goodwill. If we used fair value method or the full goodwill method, you would have shared the loss of 450 between the NCI and also what? The group group retained earnings. But for the net asset, whenever you retranslate the net asset, the exchange differences, the gain and loss you will get, the gain or loss that you get under net asset, that one will be shared between NCI and Workings 5 group retained earnings, regardless of the method that they used. Okay, regardless of the method that they used. So between Workings 4 and Workings 5, you share the exchange loss after retranslating net asset. That one, we don't care about the method that was used to value NCI, because net asset has nothing to do with the NCI or the goodwill. But if you are retranslating the goodwill, for that one, you treat it as you treat impairment. You know, impairment, if you use the proportionate method, you don't share impairment between NCI and group retained earnings. You send all the impairment loss to the group retained earnings or the consolidated retained earnings, which is working 5. But if you are working on impairment and you are using the fair value method or the full goodwill method, after getting the impairment in workings 3, the total figure will be apportioned or will be shared between workings 4, that is NCI, and workings 5. The same thing applies to exchange loss on retranslating goodwill. When you are using proportion method, you are saying that all the exchange gain or loss on goodwill is attributable to the group retained earnings workings 5. But where you use the full goodwill method or the fair value method, gain and losses will need to be apportioned between workings 5 and workings 4. Please, I hope we are okay on that side. All right. So we will determine our NCI. We move on to workings 4. Our NCI, non-controlling interest. Now, we have exchange loss that must be added to NCI's figure 218 when we share the loss after retranslating the net asset of the subsidiary. But remember, we are using the proportionate method, and we have the most easiest way of determining that figure. All right. So with that one, they said you should pick what? The NCI percentage. And then this question is NCI percentage. Multiply by the net asset at reporting. So you want to include the share of this exchange loss, 218. So if you are picking the net asset at reporting, please don't pick the subsidiary's functional currency. No. Remember, you've retranslated it to the parent currency. And that one, it was closing net asset. You retranslated and you got what? 3630. So this 3630 is in what? Dollars, or the group's presentational currency. So the moment you multiply with the NCI 3630, that one is in dollars. The moment you multiply this retranslated net asset by the NCI percentage, whatever answer you get will include this 218 already. All right. So when you are finding the net asset of this subsidiary, all right, just multiply the NCI percentage by the net asset at reporting. And at reporting was what? 7260. But that one was in cedis. So multiply it with the net asset at reporting in dollars. So the retranslated one. Okay. The retranslated one. The retranslated one. All right. Please, are you okay with that one?
Yes.
Okay. So what will be the answer? You do this, and let me also teach you the other way round.
That's
It's
So
726.
726. If you want to go by the method that you've been using, that one too, you can calculate the NCI in series. When you are down, you will translate it. So in calculating the NCI in series, it would have been what? 20% of the net asset at reporting in series. That one was 72, this one, 7260. But you see, the first 726 that we got, we picked the net assets in dollars instead of picking the net asset in cities. We picked in dollars. So if you want to go by the old approach to avoid confusion, you just know that if you are calculating NCI using the proportionate method, you pick the NCI percentage, multiply by the net asset at reporting. So if you are doing CDs, the net asset at reporting was 7260. So you multiply 20% by 7260. What do you have?
It's 1,452.
1452. But that one will be in CDs. So, 1452. So it was 20% of 7260. So when you are done, you have to convert these CDs to CDs, dollars. All right. So that one would have been 1452 divided by 2. That will give you what? Because the closing rate is 2 CDs.
It's the same.
It's the same. Yes.
726.
You see, but that one is a long method. All right. It's a long approach. You need time. So just stick to the first one, right? So if you want to find the retranslated NCI at reporting, pick the NCI percentage, multiply by the retranslated net asset at reporting. So the retranslated net asset was this 3630. Multiply with the NCI, and you get this 726. And the 726 that you get here, it has already considered the share exchange. So NCI, you have treated its own. It's left with what? The parent. Right. All right. So let's move on to working fact. Group in earnings. And the group retained earnings, you calculate it in what? Dollars. Okay. You calculate it in dollars. Because the group's presentation currency is dollars. So you start with the share capital of the parent. Retained earnings of the parent. The retained earnings of the parent was what? 4,000. Look at the statement here. And the 4,000 was in dollars. If you want to confirm, here is it. Dollars. Okay. Right. You add the share of post profit workings too. You have two subsidiaries. You have Paris and what? Suez. And for Paris, you realize that the parent share of profit. Hey, I'm doing the third question. Sorry. It is just one this thing. So with whom the post profit, share of post profit, parent percentage is what? 576,000. And that one is in dollars because we retranslated the profit before sharing it. So 576. All right. There is no impairment, there is no, but remember we have to bring parent share of the exchange loss. So parents will get two parts. The first one will be the net asset, its share of loss. That one, when we share the loss, parents got what? 872, 872, 872. Plus, when we retranslated the goodwill, the whole exchange loss, 450. This one will be borne by the parents or the group because we are using proportionate method. So plus 450, all of them. If you were using full method, parents would have taken what? 80% of this 450. By this one, we are using proportions. So the parent will take all of it. All right. So one thing is that if you have other components of equity as a separate line item, let's say as part of equity, we had what? OCE, other component of equity. That will be where you treat this exchange loss. But because we don't have other components of equity, and I don't want you to treat it in translation reserve, please include it in working 5. It's the same thing, right? So what will be the goodwill, the group retained earnings? This one is in that.
It's 1322.
So what will be the total? The total is in dollars already. You don't have to retranslate everything. Then we move straight to the application of our statement. So the group is Toronto.
3254.
3254.
54.
Confirmed. 54,
Alright.
not 1.
So yes, I've corrected it. So we have Toronto Limited. So it said you should prepare. What's the requirement? Was it both P&L? Yes. So both P&L and also, so let's start with the P&L. So consolidated. Statement of profit or loss. And I think this exchange loss, if you treat it as other comprehensive, other components of equity, or you include it in working 5. In a P&L, you present it as what? Other comprehensive income. Other comprehensive income. It's not part of the main P&L. Remember. So consolidated statement of P&L, P or L, and also your other comprehensive income. For the year ended 30th June 2018. I've taken my time. I want everyone to understand what we are doing. So I said whenever you are translating the P&L items, you use the average rate. Statement of financial position, use the closing rate. I explained this morning, but let me say it again. The group presentational currency is what? Dollars. If you are retranslating P&L items, average rate, statement of financial position, closing rate, So we start with what? The revenue. So these items, revenue. So this is how you consolidate foreign subsidiary. So the parent's figure 25,000 is already in dollars. So that one you don't translate the 25,000. But for the subsidiary figure, it is presented in cedis. Revenue is 35,000 Ghanaian cedis. But you want to get it in dollars. So what do? You retranslate or you convert to dollars. So I said P&L items, retranslate using what? The average rate. So in the question, they will always give you the average rate. What is the average rate? It was 1.75, average rate 1.75. So this is how you convert. It is from cedis to dollars. So from lowest to highest, we divide. So pick the 35,000 Ghanaian cedis, divide by the average rate of 1.75, and that one will give you in dollars. If it was in dollars to cedis, you would have multiplied, but this one is cedis to dollars, so we divide. We've already done IS21. So this is how you what translate. And also there was this item. Yes. All right. So that one has closing. So this one, the favorable game. All right. So please, what is the answer? This figure. Right. So this is what we retranslated, but that one will be at the closing. Because that one is not P&L item. All right. So please, what do you have as our revenue figure?
The first one is $20,000. So we have to add the plus 3,300. So it's 21,650.
Hold on. I thought I'm doing a
Hey, no.
Yes,
Plus
I thought I was doing.
25,000.
Yes, I thought I was doing
It will
SOS.
be 46,650.
No, so it will be these two minus this. I'm coming. What does the exchange loss, the loan that they took? A minute. Yes. So intragroup transaction. There was intragroup transaction. During the year, Toronto sold goods on cash terms for $1 million to $1 million to Suhum. And you know this one is an intragroup transaction. Parent is selling to what? Subsidiary. Okay. Parent is selling to subsidiary. One will ask, why didn't we calculate unrealized profit? The information that was given did not tell us that maybe there was inventory at the end of what the reporting period. So it means everything that they sold, they bought from the parent has been sold to third parties. So we don't have any unrealized profit. So just deduct the total intragroup sales figure. And that one is in dollars already, minus 1 million. So we're hanging 3 zeros, so 1,000. All right, so Madam Zadia, you can now
So
find
44,000.
44,000. Sorry for adding the fair value gain. I thought I was doing PP. I was adding the fair value gain. All right. So the next item in the P&L is what? Operating costs. Operating costs. So the operating cost too will be the parent on 15,000. That one is in dollars already. plus that of subsidiaries own 26,250. That one is in cities. So 26,250 divided by what? 1.75. You retranslate using the closing rate. So what will be the operating cost?
$30,000.
You said
30,000.
okay. So intragroup sales, whenever there is intragroup sales, we say we deduct it from revenue and also operating costs or cost of goods sold. We don't have cost of goods sold, so we deduct it from the operating costs. Then there was intragroup loan.
29,000.
There was intragroup loan. And that intragroup loan led to what? Exchange loss of 40,000. The loan that was given to the subsidiary gave them 40,000 that we deducted from their assets. Okay, so this 40 was in cities. The 40,000 was in cities. So you add to the, because it will be a loss to the subsidiary, so it will be the loss to the group as well. So you have to add back because it's occurred as a result of what? That intragroup loan. So plus 40. But that one was what? In cities. So that one too, you
We change it to
retranslate.
dollars.
Yes.
It's 51,000.
51.
It's
This one is not 40,000.
1,000.
We are
Which
hanging three
one?
zeros. This one is 40. And this one is 15,000.
It's
So
40, not 40,000.
yes, we are hanging three zeros already. So everything we are doing
So it's
here,
40.
yes.
39,000. 0.023.
All right. So please, who is getting another figure? Hello. Oh, please let's be fast. And we have a full question to solve. That one can take about 130 minutes. The figure, someone should confirm for me because I think it should be a different figure.
Is it 12257?
No, please.
Which is not a tax.
It's
Okay.
14,000. So it's 14,000. 0.22.
Okay, give me the
0.23.
tax.
The tax is 12257.
Yes, but I'm talking about the
Plus
operating cost.
plus 15,000. So I
Oh,
know.
I'm talking about this
I
operating
know.
cost.
29,000.
Mhm.
0.23.
Yes. All right. So what will be the profit before tax?
7720.
Come again.
7720.
7720.
It's 14799.
977.
Oh, sorry, I'm wrong. Oh. I was thinking, I didn't put the tax there.
Madam, mm-hmm,
14,000. Eh?
uh-huh.
14,977.
Yes, it says 799. All right. So what will be the profit for the year? When you are done, you bring your other comprehensive income.
Two seven two zero.
27234.
Which one?
Is it 7 or 1? Is it 251 or 257?
257.
It's 27234. Oh.
No J is getting. Yeah, 2720 is correct. All right. So other comprehensive income, you bring your exchange loss, whether exchange loss or exchange gain, please, due to this retranslation of net assets or retranslation of goodwill, we are saying treat it as other comprehensive income. So the total exchange losses will be, and we translated the net asset, the exchange loss was 1090. Now, and don't pick NCI or parent. Pick the total, the one that you shared, 191090. Okay, so that will be the first exchange loss due to retranslation of net assets. Then, what will be the exchange loss? If it is exchange gain, add. Okay, you deduct from it. Exchange loss, it's two losses, so add. The exchange loss after retranslating goodwill was 450,000. So plus the 450. And all will be treated as other comprehensive income. Don't add it to the P&L. So what will be the total comprehensive income? So first of all, give me the total exchange loss before we go on to the total comprehensive income. So please, just these figures. So we have five. And so please, didn't be those two people there.
It's 1,540.
And let's deduct the other comprehensive income from the profit for the year.
1,180.
So you move on to external financial position, Toronto Group. All right. So now on to Dallas. Okay, Dallas. That's our group's presentational currency. So we start with what? Let's, with the help of the So we start with assets. And the asset investment in Sumo will be out. So we start with the non-current assets. So here, parent is already in dollars, so 10,000 plus subsidiaries Ghanaian is 3,000. So you retranslate the consolidated statement of financial position using the closing rate. The closing rate was what? 2 cedis. Yes, 30th June. The rate is 2 cedis. So divided by 2. So in the consolidated statement of financial position, you retranslate using the closing rate. In the P&L, you retranslate using the average rate. Okay. We also had fair value gain due to increase in the land. Okay. The fair value gain was 3,300. So that one, was it in cedis or dollars? It was in cedis. 3,300. It was in cedis. So that one to retranslate. I think that will be all. We don't have anything for PPE again. Current asset is $5,000 plus 2,000 cedis. So that one to you retranslate. All right. And they said that the loan, 400,000, was a short-term loan to Sumo. So that one is intra-group loan, but this one is not a long-term loan. It was a short-term loan. So it will be treated as what? A current asset. So that one, you deduct 400. That one is in dollars already, so you don't have to worry. You deduct 400 from current assets. When you get to liabilities to deduct 400, it's an intra-group short-term loan. You are eliminating it. So it's like eliminating a receivable and a payable. Right? You've done intra-group transaction. All right. So now no one will give me the NCA.
13,150.
Please, let's all
13,150.
Shouldn't be 1%.
Current asset 5,600.
What will be the total assets? Sorry, you have to bring the goodwill. So good working. Sorry. So when we retranslated, we got what? 1,350. Don't use the cedis one. Use the dollars. 1,350.
$2,100.
So we move on to the equity and liability. So we have equity capital as the same as our share capital. We don't have any share exchange. That was not recorded. So record parent equity capital 6,000. Right? The retained earnings will be replaced with what? Group retained earnings working 5. Right after working 5, we will have our NCI, non-controlling interest, working 4. So working 4 and 5 figures. Working 5 got 3,254, working 4 726. So 3254726. So I said that the exchange loss, you can either treat it in the workings 5 or you can treat it as a separate line item called translation reserve. So if not what we did in workings 5, we deducted exchange loss, the total exchange loss in workings 5, you would have written translation reserve. Okay, translation. And this one, the reserve be a -1. Okay, but we treated it in workings 5. But if you have this line item as part of the statement, other components of equity, the next question will teach us that. If you have this as part of the equity item in a question, please, the exchange losses and gains must be treated in OCE instead of workings 5. But this one, we had nothing like that. That's why we treated in workings 5. So what is the total equity? Okay. 9254 plus 726.
Off the air condition. It's raining. Off the air condition.
9980.
So let's bring our liabilities. It is $10,000 plus 1,000 cedis minus the short-term loan you deduct from liabilities because we deducted from current assets. For 10,000 plus 500, 10,500 plus this 10,000. Oh, then the exchange loss.
10,100.
The exchange loss will come here. You see the loan of 400, this one, the 40, we recorded it as a loss to the parent. So it should be a liability. They even said it here, it is recorded in the liability. The liability is recorded by Sum Limited at the historic rate. So it's recorded in what? Sum's liability. So if you are consolidating, add that exchange loss. That exchange loss was not due to retranslation. It was as a result of what? The loan acquired from the parent. So it was 40,000. And that one was in cedis. So we translate that one. We are doing SOFP. So we will retranslate using the closing rate, not the historical rate or the average rate. This one is SOFP. Yeah, so what will be the total liability?
$10120.
So what will be the total equity and liability?
$2,100.
All right. So I think there was nothing extraordinary there, but still, do you understand the illustration one? Any question you want to ask in illustration? Because illustration it is very lengthy, so I'll speed up things. So if you don't understand anything, the basic thing we've done in consolidation of foreign subsidiary, how to do the retranslation, how the exchange losses and gains are treated, and all that. Are you all okay? Because I'm going to speed up with the illustration too. Because if you don't speed up, it can take us like 2 hours. All right. So if there's no question, please let's introduce ourselves to illustration 2. So quickly, someone should read that one for me. So with that one, we start with skeleton before we move on to.
Rome. Illustration 2. And I read Rome, a public limited company, operates in the mining sector. The draft statements of financial position are as follows. At 30th April 2018, Rome, Paris, and Swiss. Assets. Under assets, we have non-current assets, property, plant, and equipment, investment in subsidiaries, Paris, Swiss, financial assets, current assets, then our total assets, equity, liabilities, share capital, retained earnings, other components of equity, total equity, non-current liabilities, current liabilities, total liabilities, and we have our total equity liabilities. The following information is relevant to preparation of group financial statement.
All right. So, madam, please, a minute. Before she continues, please kindly take critical attention, because the informations are plenty. So I'm not going to explain it once she has done reading it. We just move straight to the workings. So take notes and pick the key items yourself. All right. So, madam, continue.
Okay, so 1. On 1st May 2017, Rome acquired 70% of the equity interest of Paris, a public limited company. The purchase consideration comprised cash of $94 million. The fair value of the identifiable net assets recognized by Paris was $120 million, excluding the parent deal. The identifiable net assets of Paris at 1st May 2017 included a patent which had a fair value of $4 million. This had not been recognized in the financial statements of Paris. The patent had a remaining term of 4 years to run at that date and is not renewable. The retained earnings of Paris were $49 million, and other components of equity were $3 million at the date of acquisition. The remaining assets of the fair value of the net asset is due to an increase in the value of land. Rome wishes to use the full goodwill method. The fair value of the non-controlling interest in Paris was $46 million on 1st May 2017. There have been no issues of ordinary shares since acquisition, and goodwill on acquisition is not impaired. Rome acquired a further 10% interest from the non-controlling interest in Paris on 30th April 2018 for a cash consideration of $19 million. 2. Rome acquired 52% of the ordinary shares of Swiss on 1st May 2017 when Swiss's retained earnings were 220 million Ghana cedis. The fair value of the identifiable net assets of Swiss on 1st May 2017 was $495 million, Ghana cedis. The excess of the fair value over the net asset of Switch is due to an increase in the value of land. The fair value of the non-controlling interest in Switch at 1st May 2017 was 250 million Ghana cedis. 3. Switch is located in a foreign country and operates a mine. The income of the Switch is denominated and settled in Ghana cedis. The output of the mine is routinely traded in Ghana cedis, and its price is determined initially by local supply and demand. Switch pays 40% of its costs and expenses in dollars, with the remainder being incurred locally and settled in Ghana cedis. Switch management has a considerable degree of authority and autonomy in carrying out the operation of Switch and is not dependent upon group companies for finance. Rome wishes to use the full goodwill method to consolidate the financial statements of Switch. There have been no issues of ordinary shares and no impairment of goodwill since acquisition. The following exchange rates are relevant to the preparation of the group financial statement. 1st May 2017, Ghana cedi to a dollar is 6. 30th April 2018, for a year to 30th April 2018 is 5.8. 5. Rome has a property located in the same country as Switch. The property was acquired on 1st May 2017 and is carried at a cost of 30 million Ghana cedis. The property is depreciated over 20 years on the straight line method. At 30th April 2018, the property was revalued to 35 million Ghana cedis. Depreciation has been charged for the year, but revaluation has not been taken into account in the preparation of the financial statement as at 30th April 2018. 6. Rome purchased plant for $20 million on 1st May 2014, which an estimated useful life of 6 years. Its estimated residual value at that date was $1.4 million. $1.4 million. At 1st May 2017, the estimated residual value changed to $2.4 million. The change is the residual value. The change is the residual value has not been taken. The change in the residual value has not been taken into account when preparing the financial statement as at 30th April 2018. Required, prepare a consolidated statement of financial position of the Rome Group at 30th April 2018 in accordance with the International Financial Reporting Standard, showing the exchange difference arising on the translation of Switch net asset. Then it said ignore deferred taxation. Thank you.
Thank you.
By the time you finish reading.
So that's why it's very important to take notes of the items when reading the additional information. You just
excellent ones.
Yes.
Excellent ones. Yeah.
So We should start with our skeleton because of the work that we will do. Let's start with our skeleton. So we will start with assets. So there was this parent company, Rome, with two subsidiaries. So these two subsidiaries, we are not doing vertical or mixed group. None of them is what? Subsidiary. They are different subsidiaries. Okay. Last that question was like that. See how the question that came, it was the parent was having two subsidiaries. It wasn't a subsidiary and a main subsidiary, just two main subsidiaries. Okay, so that's that for you. So with this one, the question started with non-current assets. So you do your skeleton with the help of what? The individual statement that has been given to you. PPE, by an examination, please write it in full. Property, plant, and equipment. Right? Now, the presentational currency is in what? Cedis, dollars for the group. Even for the parent, you pick that of the parent. So for parent and one of the subsidiaries, Paris, their presentational currency is what? Dollars. But if you take the second subsidiary, Swiss, that one, its presentational currency is in what? Cedis. So that one, you are going to what? Translate using the closing rate. Using the closing rate. So in this question, the closing rate was what? 5. Acquisition rate was 6. All right. So you can do the translation of certain items like PP and all that. So 370, that one is in dollars, you don't have problem. 110 is also in dollars, you don't have problem. But Swiss own is in what? Cedis. So we have to translate to dollars. So that one, from lower currency to the higher currency, it will be 380, all right, divided by the closing rate. And as we determined in the additional information, the closing rate 30th April is 5 cedis to $1. So we do this. Don't close it because you have some fair value gains and other adjustments to make to PP. All right. Investment in subsidiaries. By the time you finish, you know that this 113 is the total amount incurred in Paris. 46 is the total amount incurred in what? Swiss. So these two will be out. So we move on to financial assets. Whenever they add investment in maybe a subsidiary and an associate, know that that one won't pop up in what? The main consolidated statement of financial position account. So with the financial assets, that one, 15 plus 7 plus the 50 was in cedis, so we translate it 50 over 5. Don't close it. You don't know, maybe if you have an additional item affecting financial assets. Then that is all for the assets. You bring your goodwill. Now, before you start the skeleton, make sure you've read the additional information to know the items you are expecting in the consolidated statement of financial position. So when we were reading the additional information, we heard of patent that was not recorded. That one is a non-current asset. Add it. You come back to 8 figure. Okay, come back to 8 figure. So that will be all for your non-current assets. Now you leave a line, your current assets. That one, we don't have inventory and all that is in one line item. So it is $118 plus $100 plus 330 Ghanaian cedis. So we translate. That one, you don't know what will affect it. The next line will give you your total assets. You leave 2 lines, equity and liabilities. You have your share capital. There was no share exchange. So this one straight away record the share capital of the parent, 158. 158 or 158. Yeah. That's the only thing you can record as at now. Right? Retained earnings will be replaced with what? Group retained earnings. Workings 5. Then after group retained earnings, just add your NCI. Okay, add your NCI. Or bring the other component of equity when you are done, add the NCI. So other component of equity, because there is other component of equity as a single line item here, the exchange gains and losses due to retranslation will be treated in other components of equity, and that one you open workings for it, working 6, right? Before you come to your NCI examination, write it in 4, workings 4. You add all the equity items to get your total equity. Then you leave a line, you come to what? The non-current liabilities. You don't know anything affecting, or you don't know if there will be a figure in non-current, so just pick the figures. $56 plus $42 plus 160 million. So this one will be retranslated using the closing rate. Current liabilities. That one is what? 185 plus 77 plus 100 divided by 5. All right. Then you get our total equity. If you want to follow the format, just determine your total liabilities first. On the other line, will separate it, and you also bring your total equity and liabilities. So this is how you prepare your skeleton, right? So you move straight to the workings. So we are moving fast, okay? Because the workings, if we joke, we can take about 2 hours. That's why I said console should be your last question that you do in examination hall. So this one, you can't say all workings in so and so, all workings in that, leave it. So start with the group structure. Parent company was what? Rome. Parent acquired one subsidiary and also the other. So parents acquired. So Rome acquired 70% of Paris. And they later on acquired extra 10%. So that is a step acquisition, control to control. So this question is all in one. There's intergroup transaction, step acquisition, and all that. So Rome acquired a further 10% interest from the non-controlling interest in Paris on 30th April 2018. But mind you, control was achieved on the first acquisition. So you start consolidating from the 1st May, not 30th April, the second acquisition, right? This one is control to control. Remember, we've done control to control. So this one, you only, after determining the goodwill on the first date, and the second date, you only determine what? Increase or the reduction in NCI, okay? Because your NCI will decrease. All right, so plus the extra 10%. So meaning that Rome is now having 80% as at the 30th April 2018 in what? Paris. So the consolidation date will start from the first acquisition, the 70%, that one 1st May 2017 to the reporting date, 30th April 18. All right. Now the second one was that Rome acquired 52% of the ordinary shares of Swiss on 1st May 2017. So that one is 52%. So that one to the consolidation period is 1st May 2017 to reporting date 30th April 2018. How many years do you have? What's the post-action period?
It's a year.
Yeah. All right. So we move on to the net assets. Now, this is what you must take note of. The two subsidiaries. For Rome, for Paris, you see, Paris operates with what? Or the presentation currency for Paris was in dollars. So when you come to Paris, we don't have problem in retranslating net assets and also retranslating goodwill. To just be calculated straight away. Okay. Because you see that the figures in Paris, 49 million, the retained earnings of Paris, $49 million. Other components of equity, $3 million. So for Paris, we don't have problem with uh, translation because it's already in dollars. But when it comes to Swiss, you see that the Swiss retained earnings were cities. Okay, the identifiable net asset was cities, and also the fair value of NCI of Swiss was in cities. And this statement, the additional information 3, all the plenty stuff here is just to tell you the functional currency of the Swiss, because the most useful information here is the full goodwill method. All right. And for Paris, that one too, they uses what? The full goodwill method. Okay. Paris also use the full goodwill method. Good. So Paris to Rome wishes to use the full goodwill method. So all the two are here full goodwill method. Right. So if you read what I have circled here, or is it a rectangle? Yes. So you see that all the information we have here, we learned it in IS 21. If you remember, we learned what? Determinant of functional currency. We said that for presentation currency is by choice. You can choose to present in dollars, cedis, euros, whatever. But for functional currency, it is determined by certain factors. And made of the sales, your expenditure, where you operate, whether you are you have the authority to operate as a whole without what depending on what the group. So you see everything that we said. If you read everything here, so you see Swiss is dominated and settled in city. The output of the mine is routinely traded in cities. Its price is determined initially by local supply and demand. So you see market factor, the production factors. Swiss pay just 40% in dollars. The 60% is with cities. This management has a considerable degree of autonomy and authority. So they operate on their own instead of depending on the group. So these were just the determinant. Okay, nothing useful there. Just the most important thing is what the group, the goodwill method. That's all. Right? Good. And we are saying that no impairment in what? Swiss. So for Swiss, their currency is what? Ghana cedis. So you calculate the net asset of Swiss in Ghana cedis or Ghanaian cedis first before you retranslate the opening and the closing net asset. When it comes to goodwill, to calculate goodwill of Swiss in Ghanaian cedis, when you are done, retranslate the goodwill. But for Paris, that one, it is already in dollars. So just calculate the net asset and the goodwill straightforward. You don't share, you don't retranslate it. So let's determine the net assets of the two subsidiaries. So we are determining that of Paris first. So that one you have at acquisition. So you see everything about Paris in additional information 1, and it's very lengthy. That's why I told you to pay attention. So that one, it is in dollars. Okay. So this one, no translation. So it was in dollars already. So we pick the share capital. So the share capital of Paris was 38 at acquisition and at reporting. We have other components of equity. So remember what we did under vertical and mixed group, where there's a difference in other components of equity or revaluation surplus. You subtract, right? You remember that. Good. If you've forgotten, we remind ourselves today. All right. So What next? The retained earnings will come. So at reporting is in the statement, as we know, 56. At acquisition is in the additional information 1. When on 1st May, what was the retained earnings of Paris? They said that the retained earnings were 49 million. Okay, 49 million. Then the other component of equity on that same acquisition was other component of equity on acquisition were 3 million at the date of acquisition. So we have other component of equity at acquisition 3 million. And this one is something that we must take note of. So the other component of equity for Paris reporting is what? 4 million. Now there's a difference in this. Remember what we did under vertical and mixed group. When there's a difference in other component of equity or capital surplus or revaluation surplus, we say that take note of the difference. We don't care whether it is positive or negative. Just take note. The difference is 1, right? When you are done with this calculation, if you are sharing the profit to the parent, you deduct 1. That's what we learned. Right? You've done vertical and we solved 2 questions, and it was like that. Okay, so take note. Now, from this, they gave us the net asset, the total net asset. So it was here that they give us. So you see that the fair value of the identifiable net asset recognized by Paris was 120 million, excluding the patent. So patent is not part. You come and treat the patent. Everything they have here, they are saying that the total should give us, and this is not the first time of solving this kind of question. Okay. And I said copy reporting. This is how they examine you guys. So they will give you the total net assets and acquisition. So that one is which figure 120 million. So they said that the difference is as a result of what? Where is it? The remaining excess of the fair value of the net assets is due to an increase in the value of land. So the difference will be sort of what? Fair value gain, land. That's not the first time we are solving this kind of question. So what is the fair value gain? So it will be the summation of this. If it's not up to 120, the difference they are saying is as a result of what? Fair value gain, land. And that one will be recorded at both acquisition and at reporting. So what is this? Hello.
Huh?
30.
The difference is 30.
So that will be recorded at both acquisition and at reporting. All right. Now we have to take note of what? The patent, because the identifiable net asset that gave us 120. They said that it excluding what? The patent below. So we had patent to recognize because they said that patent, where is it? The patent had not been recorded. Where is it? It was in the statement here. So you are saying that included a patent which had a fair value of 4 million. So the patent fair value 4 million will be recorded at acquisition and at reporting. When we are done, we calculate what? Amortization, intangible assets. We amortize it. So we are saying it will be used over 4 years. All right. It will be used over 4 years. So patent had a fair value of 4 million. This had not been recognized in the statement of financial position. The patent had a remaining term of 4 years to run at that date, and it is not renewable. So it is 4 million over 4 years. So what will be the amortization? Amortization is only treated at reporting. Amortization, depreciation. There's no intra-group transaction or
One. It's one.
One. Yes. So there was no intragroup transaction where the subsidiary Paris was the seller. So that would be all. So what is at acquisition and at reporting?
$16. At acquisition is 16.
16. 16.
120. Hey. 116. Sorry.
Patent. We are adding.
116.
No, we are adding patent. Patent, its fair value. Amortization is
We are
deducted.
adding.
To 124.
Okay. 124, yes.
So what is at
At
reporting?
reporting is
124.
131.
131. So post-acquisition profit will be 131 minus 124. So we share this. It is already in dollars. Okay. It is already in dollars. So we don't have to retranslate the profit. So what is the profit? That will be in dollars. Millions. Okay.
7.
7 million. So we don't have to retranslate it. It's already in dollars. So share of post profit. Parents will get. Now, don't use 80%. Don't use 80% because 70% is where they gain control. So on the first acquisition, so everything we are doing here is as at 1st May 2017. So please use the 70%. Don't use 80%. Because on the first acquisition, they acquired or they gained control. That's what we learned under step acquisition, control to control. That one, parents will take 70%. NCI will take 30%. Now, mind you, there is what? A difference in the other components of equity, and we know what to do. Before you share the profit to the parent, you deduct that difference. So 7 minus 1. So the one that we've deducted, the 70% of the one that we deducted, we will treat it in a separate workings called other components of equity because that item gave us the difference. Okay, that's what we learned under vertical, and this is not the first time we are doing it, right? And I've explained everything to details when we were doing vertical, mixed group, and all that. All right. So what are the figures?
Parent is 4.2. NCI is 2.1.
All right, thank you very much. So let's move on to the net assets of the second subsidiary. So we are still under workings to net assets of Swiss. This one, their functional currency is what? Ghanaian cedis. So after everything, you have to retranslate. So even though their functional currency is Ghanaian cedis, their net assets and goodwill must be calculated using their functional currency. When you are done, then you will retranslate to the presentation currency for the group. So this one, you will use cedis. You will use cedis to determine the net asset and the goodwill. When you are done, we retranslate it because their figures were in cedis. So we start with the share capital, the subsidiary, all right, called Swiss. So share capital, that's the last column. Share capital is 200 cedis. So both acquisition and reporting to be 200. It is in millions, okay? We start with we present their retained earnings as well. So you see, it's the same basic knowledge that we are doing in the consolidation of a foreign subsidiary. So retained earnings, I said the one that in the statement is at reporting. So this 300 million is at reporting. And acquisition is given the preamble or the additional information. So that one was given the additional information. Additional information 2. As at the date they acquired, Rome acquired Swiss 1st May 2017. Their retained earnings were 220. So acquisition 220. Then there was no mention of what? Other component of equity. So other component of equity will be 0 for Swiss, and for at acquisition, and at reporting to it is 0. So you can choose to write other component of equity dash dash, but there's no need to bring that one because there was no mention of other components of equity as at acquisition. And if you look at the statement of financial position given to us, there is no other component of equity. So we will skip other component of equity in the net asset of what? Swiss, right? Now, this one too, they give us the identifiable net asset, the fair value of identifiable net asset as at 1st May. So they said that the fair value of the identifiable net asset of Swiss on 1st May was 495 million. So we are saying that if we add these two, it's supposed to give us 495. If there is a difference, that one is also due to an increase in the value of land. And whenever you get a fair value gain, you know there will be no depreciation because we don't depreciate. But don't say that it must be always what? Land, right? Don't say that it will always be land. If you get maybe it's due to an increase in the value of plants, that one after getting the fair value gain, you calculate depreciation on that fair value. But this one is land, we don't depreciate it. So what will be the fair value gain on land?
$75.
75. I think there was no mention of anything again. So this one too recorded both reporting. This one, there's no patent, there's nothing, so that will be all. Now let's record the fair valuation gains before I forget. That is the main reason why we do what? Skeleton first, so that you don't forget certain items. For Paris, the fair value gain we got was $30 million. So straight away dollars, PPE plus 30 million, it was in dollars. Then we record the fair value gain in Swiss. That one was in cedis. So the 75 million we have here must be recorded in the consolidated statement of financial position for the group. And that one was in cedis, 75 million to translate. So 75 divided by 5. All right, we will not close it. Maybe you have some other figures as well. So what is at acquisition and at reporting figures? We have acquisition, it's left and reporting.
575.
So post acquisition profit. So that one is 575 minus 495. So this one is in cedis.
80.
80. Now, whenever you get this, retranslate the profit. That is what we did this morning. Okay. Whenever so see, Suhum, after determining the post-acquisition profit in cedis, and that one we got what? We got 1260. This 1260. 1260. This one, right? So after that, we translated it to dollars before sharing the profit. So we translated by dividing 1.75 and we got 7,220 and we share the profit. The same thing must apply to this one. So we translate the profit. So that one will be 80 million divided by the closing rate. And that one will give us in dollars. So what will be in dollars? When you get this, you now share it. Once at this time, parent was enjoying 70%, NCI will take the remainder. Figures. Oh, 80 by 5. This is plenty. Let's be 80 by 5.
$16. 16.
For a minute. Okay. All right. So this one was, I think I made a mistake. This one was profit. So you use the average rate. The closing rate is the statement of financial position items. So average rate. So it should be 55.8. Right. Sorry for that. So with the first one too, we translated the profit using the average rate 1.75. Illustration 1.75 was the average rate. See, average rate 1.75. And that's what we use to translate the profit before sharing. So you retranslate using the average rate. Okay, 5.8.
13.79.
Thank you very much. The 5 is for the items in the statement of financial position. 13,
0.79.
so let's make it 13.8. So let's share it. So now it's in dollars, so we are good to go. When you get this place, we retranslate their net assets.
Parent is 9.7.
Oh, it's using the percentage. Hey, Johnson can.
4.1.
A minute. I'm using the percentage for the Paris, okay? But we are doing Swiss. Swiss, Rome acquired 52%.
Oh, yeah.
So please follow. As I've been saying, it means me a mistake. Correct me
52
once.
and
52, 48. So give me the figures.
Parent is 7.2.
17.2.
7.2.
Is it two exact decimal places?
I thought you were rounding up. That is why I
No, what did
rounded
you
up.
get?
7.176.
176. So let's do 1.8. 1.8. This one it was 7.9. That's why I did it 8. All right. So let's see how we take. This point
624.
624. So two decimal places will be 2. The third one is not up to 5, so 2. All right. Thank you very much. So now we retranslate it. So we bring the CD sign. We create 3 columns as we've been doing. The second one is exchange rate. And the last one will be in dollars. All right. So you have opening net asset. And opening net asset, you use the rate asset, the acquisition rate. Okay. So let me just substitute it with acquisition. So acquisition net assets. In cities, for Swiss, the acquisition net asset was 495. We retranslate this one using the acquisition rate. The date as at 1st May 2017, so acquisition rate. And that one, if you are looking at the question, acquisition rate was 6. First May 2016, so 6. So retranslate and give me in dollars. Then you come to the profit. Profit is what? The post-acquisition profit. And the post-acquisition profit in cedis, we got what? 80 million. 80 million in cedis. 80 million. So we got the 80 million. And we retranslated using what? The average rate. That was 5.8. And that gave us 13.8. So please, who is translating the net asset, the acquisition net asset for me? Oh, this figure is almost taking 1 minute. Hey, 495, translate to dollars. Please, if you are tired to, we can pause it here and we end it here. It was the energy, I don't like it at all. So this one will be the closing net asset.
82.5.
The boys, OJ and Derek, please, let's all contribute. Let's not leave it to
575.
Madam Stella, you said your figure is what?
82.5.
All right. So with the closing net asset, we translate using the closing rate. Closing rate per the question was 5. So the difference will be here, exchange gain or loss. So what is the closing net asset? Retranslated.
$115.
So do you have exchange gain or loss? Just check, add these two and compare with this. So 82.5 plus 13.8 is giving us if it's more than this, the difference will be exchange loss. If it's less than this, the difference will be exchange gain.
Gain.
So gain of
18.7.
18.7.
18.7. Thank you very much. All right. So we are done with the net assets. So now we move on to the goodwill. The goodwill to you calculate it for the 2 subsidiaries. Okay, 2 subsidiaries. Because we have different. Do you want us to do it simultaneously or we do it separately? Do you want us to do it together because they are all using the net assets? The fair value or the full goodwill method. So do you want us to calculate it subsidiary by subsidiary or we should do it
together? Let's do it together.
Okay, so goodwill calculation. We know it is fair value for the 2 subsidiaries, right? So we are saying we are doing it together. Therefore, Paris will come first and you do for what? Swiss. But Paris was in dollars. Swiss is in what? Cedis. When we are done, we must retranslate the Swiss goodwill. That's the only thing we'll do here. So we start with the cost of investment. So what was the cost of investment in Paris? The 70%. The purchase consideration of the 70% was what? 94 million. The 10 million on, we will do it when we are using this 19 million they paid. Okay, that one was for the extra 10%. That one we will do it when we are doing the control to control scenario. Okay, and that workings for. Right. So this one will be 94 million for this. So if you add the 94, the first 70%, and the extra 10%, 19 million, what do you have? I want to tell you something. 94 plus 19.
113.
113. So you see, that's the total amount they spent in Paris. So if you count the investment in subsidiary, you see 113 here. That's why this one will go off. 113. That's why that one will go off. But for goodwill calculation, we calculate goodwill when control is achieved or obtained. So here they gain control on their first acquisition. 70% is controlling interest. That's why we are using the 94, not the 113. Okay. So for cost of investment in Swiss, that one too is all right. So that one we have to do calculation. Okay. Now we have to do a calculation. I have to do it somewhere else. Okay, let me do it here. This one, Rome acquired 52% of the ordinary shares. So if you read everything on Rome, you see that the question did not tell you the amount they spent in acquiring Rome. But I've also told you that if you want the cost of investment, if it is only cash, it's the same thing here. So Swiss parents paid what? 46. 46. And the 46 is recorded in what? Dollars. It's recorded in dollars. But the Swiss functional currency is in cedis. So we will calculate goodwill in cedis before we translate to dollars. So that 46 must be translated to Ghanaian cedis. So this time around, we are converting from dollars to what? Cedis. Again, if you want to know the cost of investment in the subsidiary or associate, that one is always given as part of your asset here, investment. And they said investment in subsidiaries, 113 and 46. So the 46 is the one they invested in Swiss. There was no share exchange. There was no deferred consideration. There was no contingent consideration. So you know the 46 million there is cash component. And you know that they only record cash component under the investment side. So this 46 million is what they spent in acquiring the 52 interest in Swiss. But Swiss functional currency is Ghanaian cedis. And whenever the subsidiary functional currency is different from the group presentational currency, you determine goodwill and net assets in the subsidiary's functional currency. And based on the information that it was given in additional function 3, we realize that the functional currency is in cedis. So now we have to convert this dollars, $46 million. It is in what? Dollars, Rome, dollars, and a Rome, dollars. It spends $46 million. So you convert to cedis. And whenever you are converting from a lower currency to, from a higher currency to a lower currency, what do you do?
Multiply.
You multiply. Therefore, you multiply the 46 million here by the rate. And what rate are you going to use? Yes. What rate are you going to use? Additional information 4. What rate are you going to use? We have 3 rates, 6, 5, 5.8. What rate are you going to use?
Acquisition.
Acquisition rate. Thank you. On 1st May 2017, because the 52% was achieved on 1st May 2017. 1st May 2017. All right. 6. Good. So what will be the cost of investment for streets?
276.
276. Because everything is under in cedis. So this one is fair value method. When you get here, what next? Fair value of NCI at acquisition. Okay. If it is not given, I've taught you how to calculate it. So this one, it was given The fair value of NCI at acquisition in Paris was $46 million. For Rome, you are saying that the fair value of NCI was $250 million. The fair value of NCI, non-controlling interest in shares, on 1st May is what? $250 million. So this one, series, it's already in series. So what do you have? Whenever you get the answer, you less net assets at acquisition. There is no impairment in each of the words subsidiaries.
$140.
Which one is the 140?
Paris.
Then Suez will give you what?
$526.
So let's pick their net asset at acquisition. So for Paris, the net asset at acquisition was 124 million. So that one, 8 functional currencies, dollars. For Suez, the net asset at acquisition in series was 495, as we determined, or even the question gave us that 495. So what will be the goodwill at acquisition?
$16 for Paris.
How about Suez?
31.
Right? But you can't add total goodwill. Why? Because Suez is in what? Cities. So we have to retranslate the goodwill for Suez. There was no impairment, so goodwill at acquisition will be the same as closing goodwill or goodwill at reporting, right? So create the 3 columns. So CD, exchange rate, then dollars. So the acquisition goodwill, we don't have opening goodwill. So acquisition goodwill in series was 31. Exchange rate to use will be the acquisition rate. 1st May 2017. And in the question, acquisition rate was what? 6. So find the retranslation for me. There was no impairment, all right? So you will align, then you record your closing goodwill or goodwill at report. So 186. 186. Senior, you multiplied. You are converting cities to dollars. So from lowest to
5.16.
5.16. Do you have any other figure behind?
666.
1.1666.
Yeah.
So 2 decimal places will be 17. All right. You have closing goodwill. The closing goodwill is the same as what opening goodwill or acquisition goodwill because there was no impairment. But the rate translation will not be the same as a result of the rate. Closing rate in the question, 30th April is what? 2018 is 5. So what will be the closing rate?
$6.2.
So do you have exchange gain or exchange loss?
Again.
gain of
1.03.
So total goodwill will be the $16 million for Paris plus the 6.2 million for Swiss because now it's in dollars. So what will be the total goodwill?
$22.2.
22.2. So don't waste time. Go to your skeleton, add goodwill, working straight, 22.2. All right. Now, the exchange gain, we got one after translating net assets. That was 18.7. We got one after translating goodwill. So let's add the exchange gain as well. So total exchange gain. We can share it after doing net assets. This one after getting this, share it. But I didn't share it here because I wanted to add to the exchange gain that you get here before we share, or it will become two exchange gains. If you like to, okay. Now the reason why I'm adding here is that we are using the fair value method or the full goodwill method. So the exchange difference as a result of what? Translating the goodwill will be shared between working 5 and working 4, group and what? NCI. The same thing applies to goodwill. The exchange difference will be shared between workings 4, NCI, and also workings 5, group retained earnings. So all the two-way translation differences, we will share it. But if you were using the proportionate method, I would have shared the exchange difference as a result of what? Retranslation of net asset, this 18.7. For the goodwill, we wouldn't have what? Shared it between NCI and group retained earnings. All the difference will be carried to what? Workings 5. But this one is fair value method. So we will share the difference that we got under goodwill and also the difference that we got under net asset. Take note. That is why I want to add the exchange gains. So total exchange gains, the one that we got from retranslating net asset was 18.7. Then the one we got after translating goodwill is what? 1.03 million. So what will be our total exchange gains? Then we share it. What will be the total? And it is all happening as a result of what? Swiss. So use the Swiss percentage.
$19.73.
19. So times 19.73 times 19.73.
Parent is 10.26.
NCI is
9.47.
all right. So this NCI go to workings 4 is again. So you add 9.47. But the parent here, initially we were recording it under group workings 5, group retained earnings workings 5. But this one, in the question that we have, we have other components of equity as a single line item. Therefore, all exchange gains must be treated in the other component of equity. And remember, we subtracted something from the profit before we shared here because of the difference in what other components of equity. So you open workings for other components of equity and we record the exchange gains, the parent share to that place. All right, so this will be the end of workings 3. So we move on to workings 4, NCI. This is fair value method. So first of all, the NCI for Paris. We pick the fair value of NCI at acquisition. And here everything will be in dollars. Okay. So here fair value of NCI at acquisition was given in the question as even we did it in our goodwill here. Paris was what? 46 million. Then we add what? Share of post profit. Share of post profit. And share of post profit workings 2, that was million. NCI got what? 6.62. 6.62. 6.62. Now, this extra 10% they acquired. We've done disposal scenarios, control to control. Rome acquired further 10% interest from the non-controlling interest in Paris on what? On 30th April 2018 for a cash consideration of 19 million. And that one will land in what? Reduction in NCI. We've done disposal scenarios. So when they acquired extra percentage, control to control, that one ends in what? Decrease in what? NCI. So the decrease in NCI, here, let's solve for it. Let's say workings 4I. Okay, workings 4I. So let's do the reduction in NCI. We know how it is done, right? We know how it is done. Okay. All right, so space. Okay, so let's calculate the reduction in NCI. I hope you remember the formula. The additional interest acquired, 10%, divided by, let's remove the 10 percentage. The additional interest acquired, 10%, it was the additional interest. And what was the OCI, the old NCI, the old or previous NCI before they acquired additional? The old NCI will be 30 because initially they were controlling 70. So old NCI will be 30 before they acquired the extra 10. Times the current value of NCI as at what? 30th April 2018. Okay, times the current value of NCI as at 30th April 2018. And so let's say working 4I. What is the current value of NCI as at 30th April 2018? So that one, to get that, we start with what? The fair value of NCI. That one was 46 million. Then we add what? Share of post profit. Okay, share of post profit. So what will be the share of post profit as at the 30th April 2018? Hello. Are you all tired? Hello.
Yeah, I'm coming. Is the NCI right?
Yeah, so you see the so the Paris, this one the 6.2, I think it was for Swiss. I think this-
Paris was 2.1. The
Yes,
share
so
of post profit
that's
was
what
20.
I'm trying to correct. You see, I picked the share of post profit for Swiss 6.62. Okay, so it's 2.10 rather 2.10. So for Paris, it's 2.10. So the current value as at the 30th April will be the summation of the two, right? So that's why we are trying to determine here. So share of post profit. That will be the current value of NCI as at 2.1 as at 30th April. So it will be what?
48.1.
48.1. Yes, and that's why you multiply with the fraction we have here. It shouldn't be new thing to you, please. We've done disposal scenario, control to control, and we did this. It's not a new thing to us. So let's not see stars. I beg you. Solve more examples like this. Step acquisitions. This one is not disposals. Step acquisition, control to control. Step acquisition, control to control. So what's the figure? What's the reduction in value? And we said the journal entries, the double entries, or let me say the journal entries. This one is step acquisition. Do we credit or debit cash? Do we credit or debit cash? Step acquisition, control to control. Were we crediting cash or debiting cash? Hey, see, we started the question like 2 something or see, it's almost 4 o'clock. I told you. Please, step acquisition, control to control. Were we crediting cash or debiting cash? Hello. Now, step acquisition, you
We are
acquired
crediting
extra.
cash.
Crediting. So you credit cash. The cash that you paid was 19 million. The extra 10%, you paid 19 million. Then you debit what? Reduction in NCI. So the reduction in NCI, what is the amount? 10 over 30 times 48.1.
16.03.
So we debited 16.03. The difference, is it a decrease or increase in OCI? OCE, other component of equity. So this one will be a decrease. So you debit the decrease in other component of equity. What is the figure for that one? And what's the balancing figure? Balancing figure. Hey, if you are tired, you can tell me so that we can close. Because, hey, yeah,
It's
2.97.
2.97.
tip time, I'm planning a post now. I'm planning tip time. So there was a reduction in NCI. That one we said reduction in NCI. Even you are debiting NCI. NCI is having a credit balance. If you are debiting, it means what you are deducting. And even the name reduction in NCI. So NCI will reduce as a result of the step acquisition by what? 16.03. That's what we use the formula. 16.03 million. Now, this decrease in OCE, other components of equity, 2.97, we will treat it. Remember, we will deduct it from the workings called other components of equity. That should be working 6 or working 7. That's where we will treat that, and that's where we also treat the exchange gains. Don't forget the parent exchange gains. Okay, so now let's come to this is the NCI for Paris. So now let's determine the NCI for Suez. What was the fair value of NCI at acquisition? Now that one was given in cedis, so we have to retranslate to dollars because we want the NCI in dollars. The NCI for Rome, additional information 2, was 250 million cedis, right? So we retranslate. We want the NCI at reporting, so we retranslate using the closing rate. The closing rate was 5. Okay, the closing rate was 5. Hey, sorry, this one is 1st May, the 250 acquisition at acquisition. So it should be the acquisition rate at acquisition. Even the date is 1st May, and the 1st May, the rate was what? 6. So then we add the share of post profit workings 2. And after doing the retranslation, sharing the profit for Suez, we got what? 6.62 of the total 13.8. So 6.62. That one, it was in dollars already. So please translate this 250 over 6 for me.
42.
You have 41 point what?
41.6.
Yeah, so this one, if it is 0.9, that one you can say 42. This one, there's a huge difference, okay? So 41.6, is it 6 or we have other figures? 7.
6.
Yes, so this one, if it is 41.9, you can do it 42. Okay, so if it is this, leave it like this. Okay, so I think that will be all. And I nearly forgot one thing, the share of exchange gains, NCI's own. Okay, 9.47. I said I to come to this place. So share of exchange gains. The total exchange gains we've added and we shared it. So that one was found under working 3, 9.47 million. It was in dollars, so we don't have to translate. So please, what was the NCI at reporting? When we are done, we move straight to workings 5, group it in it. Then we move straight to
89.83.
89.83. All right. So NCI, straight to your skeleton. NCI 89.83. Workings for 89.83. Okay, so we move on to workings 5. Now, before we move on to workings 5, because there was what? Additional PPE, okay, and that one, it was Rome who acquired it. So anything, if there will be revaluation surplus or anything, it will affect workings 5. So let's do that one first. So we had 4I to do the reduction in NCI. Let's do 4II to calculate the illustration 5 and what? 6. The parent purchased what? Plant, and also they purchased a particular property. So let's do the property first, right? Property. And that one, you know, it will be affecting what? PPE. So if there is a gain or anything. So let's read illustration 5. They said that parent, okay, has a property in Ghana. That's where Suez is. The property was acquired on 1st May. So the costs or the property, it was acquired 1st May 2017. So you see PPE in addition information 5 and 6. So 1st May 2017, the cost was 30 million. So depreciation.
Eji.
Hello. Hey, Madam Sadia. Okay. So the depreciation, we are saying that depreciation has been charged for the year, but revaluation has not taken place to account. So how many years are you to charge depreciation? So I said that determine your carrying amount up to the date of the revaluation. That's what we did under PPE. So the revaluation occurred on what? 30th April 2018. So we have to determine our carrying amount as at 30th April 2018. And that's what we did. Okay, that's what we did. That is what we did. So we determined the carrying amount as at 30th April 2018. So how many years are we charging the depreciation? How many years?
1.
1 year.
1 year. Thank you very much. But even with this one, the property was in cedis. We want it in dollars. So we translate using the acquisition rate 6 for 1st May. So the cost will be $5 million. The 30 million was in cedis, right? We are doing everything in dollars. Good. So the depreciation, we are saying 1 year. So it will be $5 million. Over the useful life of the asset, we said it is what? 20 years. It was not having any residual amount or residual value. So 20 years. We said we are calculating just for 1 year. So what will be that? What will be the depreciation for this? So to be depreciation for just one. Come again.
25.
25.
0.25.
All right. So the current amount will be 4.75, right? Right.
Yes.
Now the revalued amount. The revalued amount, that one is also as at 30th April 2018. So we can now compare. The revalued amount was what? 35 million. And the 35 million was in cedis. So that is why I told you when we were doing IS21, we even did the illustration there. I said that for non-monetary items, you don't translate their figures. But for the purpose of revaluation, you translate the revalued amount. So we are not translating the carried amount of the PPE or the property. We are not translating the 4.75, but we are rather translating the revalued amount. The revalued amount was in cedis, but we want it in dollars, right? So we have to translate it to cedis. So it will be the 35 million divided by what? As at the 30th April 2018 closing rate. So 30th April 2018 is what? 5. So we divide by 5. So this is what I was telling you. For non-monetary items, property is a non-monetary item. We don't retranslate the figure at the end of the reporting period. But if that property or the non-monetary item has been revalued, you retranslate the revalued amount, not the property amount, just the revalued amount. That's what I said under IS21. And we saw, for example, like that, even it was a past question. So what will be the revalued amount retranslated?
7.
7.
The difference is 2.25.
2.25. And that one is a revaluation surplus, right? And this revaluation surplus will go to against 5. you add it to the group retained earnings because it was Rome parent who purchased it. So the revaluation surplus will be added to group retained earnings and also the consolidated statement of financial position plus 2.25. And that one was in dollars already, so plus 2.25. We are done with illustration. Addition information 5. PP, okay, PP. So now we move on to III, for II. Plant, room purchase additional item called plant. So this one, we want it in dollars. So this one, it was purchased on 1st May 2014. So this one, the cost. And it was purchased on 1st May. $2014. The cost was what? 20 million. 20 million was in dollars already. All right. Now, we are saying that it is having an estimated useful life of 6 years. And the residual value at that date was 1.4 million. Okay. Now, they said that as at 1st May 2017, the estimated residual value changed to 2.26. So the residual value or the scrap value has changed. So you determine the carrying amount as at the date that the carrying value or the estimated residual value changed. So it will be like this. You calculate depreciation for a number of years, and a number of years will depend on the date. So we are determining our carrying amount as at the date that the estimated residual value changed, and it changed on what? As at acquisition date, 1st May 2017. So we determined the first carrying amount as at 1st May 2017. So what will be the accumulated depreciation that we are going to calculate? How many years? How many years?
3 years.
3 years. So it will be 20 million, which is in dollars already, divided by useful life of 6, right? Multiplied by the 3 years. So what will be the depreciation for those 3 years from 2014 to 17?
10.
Is it
10 million.
Is it 10 exact figure? Oh, we forgot something here. It is having a residual value, and it's cost minus residual value over useful life. So 1.4. Okay, don't forget the formula for depreciation. The ones that we've been doing is always residual value is 0. That's why we don't bring it. But if you have residual value, deduct it from the cost before you divide by the useful life, estimated useful life. Okay. So what will be the depreciation now? Depreciation, please.
9.3.
So what will be the carrying amount as at the 1st May 2017?
$10.7.
Now, because the estimated useful life was revised, we must use that one to calculate our depreciation as at what? 30th April 2018, or depreciation charge for 2018, right? So the depreciation from 1st May 2017 to 30th April 2018 is the same as depreciation for 2018. Will be, so it's just like how we work with revaluation. We said after revaluation, we depreciate the asset using the revalued figure. So this one too, the residual value has changed. So if you are finding depreciation after the revalued estimated residual value has changed, don't use the original cost or the historical cost. Use the carrying amount as at that date. So the carrying amount as at that date was 10.70, this, minus the revised useful life. So he said that the estimated useful value, sorry, the revised useful value, okay, The revised useful value is now 2.6 million. So minus 2.6 divided by, now the total useful asset, useful life of the asset was 6 years. We've used 3 years, therefore the remaining useful life will be 3 years. So you do it just like you do for revaluation. You said after revaluation, you depreciate the asset using the revalued or the revalued figure and also the remaining useful life. And this one, whenever there's a change to the residual value of a particular PPE, the depreciation will be the current amount as at the date the residual value changed minus the revised residual value over the remaining useful life, not the total useful life. Because if you are in 2017, it is left to 3 years. It was in 2014 that was left with 6 years, but now we are in 2017, so it's left with 3 years. So what is that depreciation?
2.7.
2.7. So the last statement, okay, so this one will give us 8, right? The last statement said that the change in the residual value has not been taken into account when preparing the financial statement as at 30th April 2017. So that means that they've recorded the purchase of the assets, but they did not consider the change in residual value. Okay, residual value. And the first one too, it was revaluation that was not recorded. It was not the plant itself, the property itself. Okay, they said it here. Depreciation has been charged for the year, but the revaluation has not been taken into account in the preparation of the financial statement. Then when they say this, it means they've recorded the depreciation, the item itself, with the exception of what? Revaluation differences. So with this one too, they said that the change in the residual value has not been taken into consideration, but they recorded the plant itself. So don't go and add +8. Rather, you add this. So you are going to find something called change in depreciation or excess depreciation, but you just name it change depreciation. So whenever there's a change in residual value to a PPE, this is what you do. So change in depreciation, yes, there will be a change in depreciation because of the changes in the residual value. So what was the original depreciation? The annual original depreciation. The first one we calculated was accumulated. So what was the annual, the yearly original depreciation? So the yearly depreciation is just 20 million divided minus 1.4 divided by 6. Don't multiply by 3. We just want the yearly ones. When the residual value was 1.4, what was the annual depreciation charge? So it is the 20 million minus the residual value of 1.4 million divided by the useful life of 6 years. Don't multiply by any 3. We just want the yearly one. We want to know the change in depreciation. When we are done, we compare it with the revised depreciation. So when the useful estimated residual value was revised, the depreciation charge, the annual was 2.7. Please, what is the annual original depreciation? The original depreciation, the yearly one, not the accumulated. This one was the accumulated. 9.3 was the accumulated one. Oh, I've even written the thing here. So this small question, we are spending almost 3 hours. Please,